Good evening, everyone, and thank you again for joining us for the Do's and Don'ts of Quant Trading webinar with Dr. Ernest Chan. Dr. Ernest Chan is the managing member of QTS Capital Management, a commodity pool operator and trading advisor. He began his career as a machine learning researcher at IBM's Human Language Technologies Group and later joined Morgan Stanley's data mining group. He was also a quantitative researcher and proprietary trader for Credit Suisse. Ernie is the author of Machine Trading, Algorithmic Trading, and Quantitative Trading, all published by Wiley, and a popular financial blogger at epchan.blogspot.com. He also teaches at the Master of Science in Predictive Analytics program at Northwestern University. He received his Ph.D. in theoretical physics from Cornell University. Just a few reminders before I hand it over. First, Ernie will also be joining us at QuantCon, which is April 28th, so be sure to check that out. And if you have any questions, please put them in the questions bar on the side. We usually get a lot of questions, and we'll do our best to get to it. I will hand this off to Ernie now. Thank you, Ernie.
Thank you, Phoebe, and thanks very much for inviting me tonight, and thanks everybody for coming to my webinar. So let me first break some bad news to you about quant trading at this time of its history. Well, there's no getting around it. Life is getting tougher for the quantitative trader. I quote D.E. Shaw, who told Professor Andrew Lo in his new book Adaptive Markets that quantitative trading became more challenging with every passing year. And another giant in the quant trading industry, Dr. Marcos Lopez de Prado, who manages $13 billion of quant fund and who is also a keynote speaker at QuantCon in 2017 and will be here again in the upcoming QuantCon. He said unequivocally that most machine learning funds fail. Now, I myself have been focusing a lot in Forex trading in the recent years, and I follow closely this benchmark for Forex traders called the Barclay FX Index. The FX Index composes of 10 largest investable currency trading programs. Now, not all of them are quant trading, but most of the currency traders, I would say a significant portion of them does use quantitative techniques. And if we look at the last 2 years' performance, and as well as year-to-date performance, it has been uniformly negative. And these are people who manages hundreds of millions to billions of dollars, who have all the resource they have in terms of data, in terms of execution, in terms of research. It is quite a frightening situation. But all is not lost. I think that it only means that just like any other industry, this industry is maturing, and in order to survive or succeed in this field, we have to up our game. And tonight, what I'm going to talk about is some of the high-level lessons that I've learned in the last 10 years of quantitative trading, and how I feel what the next step is in order to up our game. When I wrote my first book, Quantitative Trading, I said that basically every individual independent trader can succeed in quantitative trading. Now, it is no longer as easy as that at the present time. We need to do something a little bit different now. And I want to highlight what it is that I've learned since I wrote my first book in order to continue to succeed in this field. So first of all, let's talk about some of the things that we shouldn't do. And what, these are the things that a lot of them, I practically have violated every one of them, and I learned my lessons. So that's why I put them on the don't do screen. It is because I have done all of them to my regret. So one of the biggest temptation in trading, not just quant trading, but trading in general, is that we tend to lever too high when the times are good, when our strategy work. Now, it is the case that almost every strategy work for some period of time just by random, dumb luck. Okay, and if we were so lucky or unlucky, you might say in retrospect, to start trading in a period that is in a regime that is particularly favorable to the strategy, you would think that you have discovered a gold mine. I had that experience before, and you thought that your strategy is the greatest in the world. It just cannot lose. And indeed, if you look at a lot of strategy, when you trade it live, there will be a few months, maybe even half a year, where it practically cannot lose for some reason, one reason or another. And those are the most dangerous times where, many traders will be tempted to over-lever their strategy. And even if they wisely look up Kelly formula, my favorite risk management tool, the Kelly formula, to adjust the leverage. And even if you, as is recommended, take half the Kelly, it is still much too high. And the reason for that is that the typical Kelly formula only works if the returns are Gaussian. That's number one. And most returns, as you know, are not Gaussian, and there are severe serial correlation, which render Kelly formula, the leverage that is recommended by Kelly formula, greatly overly optimistic. And furthermore, Kelly leverage is highly sensitive to the sample period. So if you are so lucky or unlucky to be running the strategy in a favorable regime, the Kelly leverage will be much too high when there is the inevitable drawdown coming up. So Kelly formula, Kelly leverage, though it is useful, it can only be used as a maximum, not the recommended leverage. And then another problem with Kelly formula, and just like the Markowitz portfolio optimization, and I have written a blog post that actually mathematically connected to Kelly formula and Markowitz optimization. Essentially, I'm optimizing the same thing, and both suffer the severe problem that it uses returns as an input, and a lot of times returns cannot be predicted precisely. You can only say that, okay, return, I have positive expected return for this strategy. That's all you can say, otherwise you wouldn't be trading it, right? So at least you know that the expected return is positive. But other than that, is it going to be 10% a year? Is it going to be 5% a year? It is extraordinarily hard to predict with any accuracy. Yet, Kelly formula, just as Markowitz portfolio optimization, depends on the ability to predict return in order to generate a optimal leverage. So clearly, that's a doomed enterprise in the beginning. You just simply cannot expect to generate any sensible leverage if you have to stick in a unpredictable return as an input. On the other hand, volatility is something that everybody can forecast quite accurately. It is quite interesting. It's a common theme in finance that while return is practically impossible to predict with any accuracy, volatility can be quite easily predicted. And there is a deep philosophical reason why that is the case, but I spoke about it in one of my talks at Quant before. I won't repeat it here, but we can utilize the predictability of volatility, however, for leverage determination, and that's what people call risk parity asset allocation or leverage determination. Essentially, you can only target the volatility of your strategy. You cannot target the return of the strategy. And as a result, your leverage should be determined by the expected volatility, or even better, by the expected drawdown. Drawdown is, again, another thing, a quantity that you might be able to predict better than return. And so one should always look at the downside of the strategy to determine leverage, not how much you can make with the strategy, because that's unpredictable, but how much you can lose with the strategy, which is actually more predictable. So it's a pessimist world, but it is the pessimist is the correct attitude when you determine leverage. Okay, so another thing that one should not do, that I have learned not to do, is to use short-term performance to determine carry leverage, to determine optimal leverage, and also to use short-term performance to pick managers. Now, that's not just my subjective opinion, although I have fallen into that trap many times. I have constantly tried to look for people that can trade part of our fund for me, and I have never succeeded in picking a manager that can replicate the his or her short-term recent performance. And is it just because I have bad luck? Is it because I am a bad interviewer, or is it because I were very bad in due diligence? Apparently, it is not. There is academic study that with the title called "The Folly of Hiring Winners and Firing Losers." It's an academic study published in 2017 that demonstrate that it is impossible. It is useless to pick a portfolio manager based on its short-term performance, because they inevitably mean revert. So very interesting that there is there's if you calculate the serial autocorrelation of performance of strategies or of particular portfolio managers, typically what you will find is that the serial correlation is negative. It is not a trending. So it is exactly opposite to what most people would pick strategies or pick managers and so forth. Right? Most people are trend followers when it comes to managers. They pick the managers who have done well in the last few months or 1 year. They pick the strategy that has done well in the last 3 months. But oftentimes that's exactly the wrong approach. They do exhibit negative autocorrelation. So what is the cure of that? Well, naturally, the cure is that you have to look for a longer track record. It's easier said than done, I know, but that's, if you don't have a long track record, you better, at least you should not use the short-term performance and expect them to trend. But the other way, there is a upside to that. There is something that you can use short-term performance for, and that is for risk management. That is to say, if the short-term performance is poor in a strategy that you have started trading, at least you should use constant proportion portfolio insurance to decrease the leverage, to decrease allocation to it. That is okay. From a risk management point of view, it is okay to decrease allocation for a strategy that has decreasing performance. But it does not mean that you should base your choice of strategy, whether you should start trading a strategy based on a short-term performance, or whether you should completely shut down a strategy based on short-term performance. A gradual reallocation for risk management purpose, that is certainly advisable. So that's another thing I've learned. And finally, on a higher level, not concerning the technical side of trading, but more on the business side of trading, I have learned also not to pocket all your profits. Many traders think of themselves not as a business person, but as a employee working for somebody else. That they will get paid a bonus, and they regard their profit as a bonus. So if you have a bonus, of course you're going to spend it. Buy a bigger house, buy a better car, travel around the world, so forth. Well, that is not what you should do if you are thinking of your trading as a business. In any business, you do not spend all your profit on the the company holiday party, for example. You would reinvest the profit in data, equipment, and personnel when you have profit, and of course, when you have drawdown, that's when these investments become important. So the profit is not just for trading. So, when you look at trading as a business, when you say we invest the profit, a lot of traders say, okay, well, I'm not spending the profit on my bigger home, but I'm spending the profit in trading a bigger portfolio. Well, that sounds a little bit better, but that's still not quite optimal, because what you should do is that you should reinvest some of the profit in investing in the business, not investing in the trading portfolio that you're trading, because investing in your business is going to make your longer term survivability much better. So you need to, in other words, essentially run your trading business like any other business, and any other business would invest profit into infrastructure improvement for, so that you're prepared for future growth. Now, I mentioned three things that you can invest in terms of a trading business. Data is one of them. So let's focus on each of these areas: data, equipment, and personnel. So let's start with data. The general rule about data is that you get what you pay for. It's very simple. Cheap data is seldom good. Good data is seldom cheap. So if you think that you are somehow able to get your hands on cheap data, do not expect that there are caveats. Okay, and unfortunately, without good data, most backtests are severely compromised. I've learned it the hard way many times over, and that problem is especially important and expensive for equity backtests, because for equity data, survivorship bias can derail your backtest. Not using the bid-ask or auction price at the close and the open is going to inflate your performance. All these are stuff that I've talked about actually in previous years of Quant. So, but that's just illustrate. I want to highlight again how important an investment in data is, and how it is usually not a very cheap proposition. Okay, so if you made a lot of money from your trading, consider spending some of it on better data. And related to that, whenever you are going to backtest a strategy, the first step is actually check the data integrity. We have found so many times that we have spent a lot of hours backtesting a strategy, only at the end find that there are problems with the data. And so in some sense, a chief data officer is as important as a chief investment officer in quantitative trading. I know, for example, a friend who worked for a very prominent quantitative fund, who used to be a portfolio manager, and suddenly now he become the head of data engineering. For many people, it might seem that that is a demotion, but to him that is not the case, because large quantitative fund has also come to realize, of course, far before I come to realize, that data integrity is critically important for quantitative trading, and that is especially true for non-price data. That is, say, if you have to deal with news data, sentiment data, in addition to price data, the data integrity is particularly important and particularly tricky to ascertain, because price you can easily double check with some alternative source, and maybe even news you can, but who is to say whether the sentiment data that you get from some vendor is correctly determined? Okay, next we talk about the next type of investment is equipment. Well, we all want faster machines, but faster machine is not just for trading execution. Faster machine is also for enhancing research productivity. Machine is always cheaper than human labor. So if you are going to hire a quant or hire a programmer, well, you should definitely make sure that this person that you hire have the best machine that he or she can work on, because otherwise you are simply wasting your money on the labor cost. In terms of machine, I have found that in lately that essentially with the advent of machine learning and then with the advent of parallel computing, you should definitely invest in a multi-core machines. You wouldn't believe how essentially with a multi-core machine and with the proper parallel computing software, whether it's in Python or MATLAB, it will speed up your research productivity 5 to 10 times easily. And again, because machine is much cheaper than labor, imagine you are essentially increasing the productivity of your investment in human labor by 5 to 10 times. That is an excellent investment. So investment in machine always yield much higher return than investing in labor in this sense, simply because the base cost is so low. Now, in addition to multi-core machine, you can certainly go for a GPU if you are interested in deep learning related research, and invest in a MATLAB parallel computing toolbox, or a Python parallel processing module if you want to utilize them quite conveniently. Now, a lot of people have found that have told me that they prefer to use cloud-based computing. So why bother to invest in hardware when I can run it on Amazon, AWS, or Google or Microsoft Cloud and so forth? Where you are renting this facility. I have actually find the opposite. I find that it is extremely hassle to get a Amazon instance started whenever I want to do research, and always remember to turn it off when I'm done with my research. I just find that detrimental to my productivity. The whole point of having a fast machine is that my research can be I can test idea as quickly as possible. I don't need to wait for an instant to start up, and I don't want to pay for it when I'm not using it. So to me, actually, I find that getting a local machine is a more cost-effective and more productive proposition than investing in cloud computing. And also, that's another interesting thing is that there is a psychological factor here as well. It is that because in a cloud computing environment, you are metered, right? The more you use it, the more you pay. So there's a psychological barrier to using it. Right. Okay. You think about doing some tests. You say, "Oh, should I bother? It costs money for me to do this test. Maybe it's not very likely you're going to succeed. So let's not do it. Let's not waste money. Let's not go through the hassle of starting an instance on Amazon." Well, that is very bad. Psychological. It's a psychological barrier to get your research done. I am quite opposed to doing research on the cloud, actually, based on these cost consideration and based on the psychological factor and not to mention that you have to transfer terabytes of data back and forth between the cloud and your local disk, and also to have to pay Amazon for storing your terabytes of data. That is just not a very favorable proposition. Okay, so finally, let's talk about the third point, the third investment, personnel. Okay, so as everybody know, we should focus on our competitive advantage. Your competitive advantage might be you are an excellent coder, or maybe you are an excellent strategist. You know a lot about the market, except you can't code a strategy, or you are a great marketer, salesperson. Okay, so or maybe you're a great operational guy, right? You never you pay full attention to how the machine is working during the trading day. So everybody has the competitive advantage, and nobody can cover all the bases. Nobody can be the best person in everything or better than everybody in everything. Okay, so naturally you need to complement your shortcoming. You have to cover your shortcoming by hiring the person that that are strong in that. And for me, for example, I hired a researcher a couple of years ago, and I find that it is a great investment, because this researcher would confront your shortcomings, will discover your blind spot. It will extend your strategy. It would improve your strategy, and it would improve your research rigor. So now, of course, I am addressing those of you who are treating trading as a very serious business, where you are prepared to not only make a living yourself, but to invest in other people to help you grow the business. But at the end of the talk, I'm going to talk about if you do not have the capital to invest in personnel, and what we can, there's still a way to deal with the situation where you can cover your comparative advantage. And I've seen many people increasingly doing it, as opposed to when I first started out maybe 10 years ago as an independent trader. So the reason that investing in personnel is becoming increasingly important is because it has been over the years, and I have seen that the best quant funds do use a team approach. Now, that is, again, a topic that is emphasized by Dr. Lopez de Prado in his new book, Advances in Financial Machine Learning. He used the term production chain, and I like to use the term conveyor belt. That is to say, in the best quant fund, you do not rely on individual superstars to create a strategy. Nobody can say which strategy is his creation or her creation. It is truly a team effort. That is very opposite to how a lot of investment bank used to function, or even how a lot of hedge fund used to function. They think that you need a genius to create a trading strategy. Well, that might be true for a short while. Maybe this genius may be able to make money for a year or two, but they could never last. I have never seen a genius last more than a couple of years in this kind of superstar environment. Yet, for the institutions such as Renaissance Technology, such as Two Sigma, such as PDT Partners, Citadel, they last for many years, okay, many decades for some of them, and still profits keep churning in. It is not because there's one or two superstars. It is because there are lots of smart people that work together, and that's another thing that I have emphasized by Dr. Lopez de Prado, and I have found it to be more and more true as well. So the era of an independent genius approach to quant trading, I can say, is over. The independent trader approach is quite over. Now, does that mean that everybody need to find a job and join a big fund? That's not necessarily true. As I said, I have increasingly found many younger traders have adopted a approach which is quite interesting, and which I think is quite promising, and I'm going to talk about it soon. So another thing I find is beneficial to improving the quality of our trading strategy is that one should study financial phenomena, not trading strategies. Spend some time in studying financial phenomena. Pretend that you are a finance professor. Finance professors don't spend all day looking for trading strategy. That's not their job. Their job is to look for interesting phenomena in the financial market and understand why these things occur like that. Example, how does the kurtosis of returns compare across different markets? Why does the volume decreases on Friday? I'm just making this up, right? Why does the option, why the stock price, for example, get pinned towards their option strike price during close to expiration. All this interesting phenomenon may or may not be tradable. Okay, they may not lead to a trading strategy, but it's interesting to study. So when you study it quite apart from the trading strategies, you will generate trading ideas that are much more robust than data mining. So if you don't understand the market, most of the time you are data mining and overfitting to certain noise. But by studying the market itself and not always thinking about creating a trading strategy out of it, you will actually come upon interesting artifacts of the market that are repeatable and that are not a result of simply overfitting to past data. So this is almost like a scientific approach to finance rather than an engineering approach, right? So for an engineer, all they are interested in is to create a strategy to make money. And so they look for all kinds of patterns that they can make money off. While this might give you short-term profit, it is very prone to data mining. It's very prone to overfitting. What I'm suggesting is that sometimes you should take a scientist approach to studying finance, which is to study phenomenon for its own intrinsic curiosity and interest, not necessarily with a view whether that they are can lead to profitable strategy. Although in the end, oftentimes, if you find interesting phenomenon that persists in the market, chances are you will be able to exploit them. Okay, so now I have always advocated that we should start with simple strategies and with good intuitive justification. I have not found success in just blindly throwing 100 technical indicators into a into a random forest and hope that it finds some rules out of it. Now you might think, okay, so if the idea is so simple, if the strategy is so simple, everybody can come up with it. How can there be competitive advantage? Why should we expect that profit will last? Why shouldn't it be arbitraged away so quickly? Well, the reason that it's not usually arbitraged away so quickly, even if the basic idea is simple, is because there are lots of bells and whistles of trading that you can impose on the simple idea. And those bells and whistles are different from different people. Simply, even if you're talking about execution, if you can optimize execution, oftentimes that's already you will be able to exploit the strategy ahead of other people, or if you can manage the risk of the strategy better, you will also be ahead of other people using the same idea. And this is very interesting that a lot of times a successful trading strategy is created through the elimination of bad trades alone, right? So, for example, if your strategy are able to only generate a Sharpe ratio of 0.5 because, you have created 6 profitable trades and you have 4 unprofitable trades. Well, it is a no-brainer to see that if you are you don't necessarily have to find more profitable trades in order to increase the Sharpe ratio. All you need to do is to take away a few of the bad trade, and all of a sudden your Sharpe ratio might double. And so that's one of the reasons why a simple idea can still work, and that is because oftentimes the difference between a successful trader and an unsuccessful trader both executing the same basic idea is that the successful trader know when not to apply that idea. It takes away this trader learns to remove some of the bad trade, just not trade on those days, and that is quite a quite powerful technique, and that's something that is not easy to arbitrage away by just subtracting, not adding. So subtraction is less easy to arbitrage away than addition in this situation. And also, simple idea is a good way to start, in order to avoid paralysis by analysis. A lot of times for a new trader, they are faced with so much information out there. Right now, it's practically every week there's a new book on trading of various sophistication. There is so many blogs, and there's so many books, and there's so many techniques. I read continuously. I read trading, finance, mathematics, computer science, whatever book continuously, and I'm still feeling that I'm grasping only a small corner of trading. And for someone who was starting out in trading, you might find quite overwhelming. Should I be an expert in machine learning? Should I study derivatives? Should I study stochastic calculus? Should I study market microstructure? There is just so much information. So there is a sense of a paralysis by analysis. You spend too much time studying. But starting with a simple strategy allow you to break through that problem and cut through all this fog and really start to build on your own experience, not on your reading, not on your studying, but on your own personal experience. As Steve Shaw said again in Andrew Lowe's book, and now analyzing the results of live trading taught us things that couldn't be learned by studying historical data. In other words, no amount of reading and no amount even of research will enable you to trade successfully unless you actually have traded live. And that I agree. That's one of the reasons why starting with a simple idea is important, because it can get you started. Okay, so but that should not be the end goal, right? So after you get started, it doesn't mean that you should stay there. It doesn't mean that you should be stuck at the simple strategy level. You can always add more predictors to the simple strategy once you started trading it. And the reason why we want to add more predictors is, single predictors are easy to replicate and they lose alphas eventually. But multiple predictors, now, even though, as I said earlier, even with single predictor, you can slow down the alpha decay by removing trades, right? But there's another way to prolong the life of single factors, single predictors, and that is to add multiple predictors. Now, going from 1 to n is a big step because of a combinatorial advantage, right? With a single factor, value factor, momentum factor, everybody can replicate that. But when you have multiple predictors, the way you combine them grows exponentially as the number of predictors. So there's a combinatorial advantage in using multiple predictors in the sense that practically no two trader would combine them in the same way, right? That's the combinatorial advantage we're talking about when you have multiple predictors. No two trader is unlikely they will pick the exact same combination out of this exponential number of combinations, right? And these predictors not only can be combined linearly, but they can also be combined non-linear via neural network, or they can be combined in layers, not in parallel, but serially. So what I mean by in layers, in other words, some of these predictors can be used as risk management. Some of these predictors can be used as allocation factors and so forth. So you can apply this predictor at different stage of the trading strategy, not in parallel. So there are so many ways to combine them, which therefore make them much more difficult to replicate, and therefore the alpha decay is much slower. And of course, when you have multiple predictors, and in particular, if you want to combine them non-linear, machine learning is often necessary, although you should definitely be aware of overfitting. So even though multiple predictors have this combinatorial advantage, there is always the danger of overfitting, and that's a topic for another day. And I'm sure that many good books are out there to address this. So finally, another important I want to conclude with on a bit of a optimistic note. Having broken the bad news to you bright and early, and that is this to say collaboration. Okay, I mentioned earlier that we should take a team approach, to quantitative trading. The independent genius approach, the days of the independent genius is over. But unless we are all joining a big firm, how are we as independent traders going to be able to leverage this other people talent? Well, not all collaboration takes place in a big corporation. Not all collaboration requires the payment of salary. I have seen many university groups of university students who band together and collaborate. So they collaborate, they form a kind of a virtual proprietary trading group of a virtual hedge fund where different people contribute different things. One might be a programming expert, one might be a mathematics expert, one might be a data science expert, and so forth. And they just contribute part of their time to collaborate to create a trading strategy. And that's something that I've seen being done a lot. And that, I think, is a way to overcome this problem that we are facing currently, which is that it's just getting harder and harder for a single person to create end-to-end trading strategies sustainably. And now collaboration can be of many different level. You can, as many of the students I come across do, you have a tight-knit collaboration of creating with the goal of creating a trading strategy or fun, or you could just be sharing ideas. You don't have to do anything except for sharing ideas. And a lot of people, again, are fearful of sharing trading ideas. And I can assure you, most of your ideas are not that original. Most of my ideas are not original, and I can be pretty sure that most of your ideas are not that original either, because I talk to a lot of people who pitch me on strategies, and their ideas not that original. So don't be afraid to share your ideas, because most of it are known by a lot of people already. And but by sharing your ideas, you will actually generate net inflow, because when you throw your idea out, when there is a debate and people push back on the idea, you actually learn something. And that's the way I find that I was able to generate a lot of strategy, is by telling people the first idea, and they come back with modification and improvement. So I actually benefit from giving other people's ideas. And in the same vein, you should try teaching. Teaching other people is even a more structured way to share ideas, and that's why I like teaching. And it not only generate feedback from your students, but it also, just by talking to people, it deepens your understanding of your existing ideas and sharpen sharpen your understanding, and also let you discover new ways of using your ideas. And I find it very beneficial. So by all means, try to teach it to somebody else when you have a trading idea. Do not try to hold it secret. I think that the idea that the trading idea is so original that you have to keep it secret, I think is very unlikely. However, that does not mean that you should give away all your competitive advantage, because, as I said, often the crucial ingredient of making a simple idea work better and last more longer than other people is not in the simple idea itself, but is in the bells and whistles that you add to it, the layers on top of it, the execution, the risk management, the trades that you don't do, not the trades that you do. So those competitive advantage, you don't have to give it away, right? So no one tells you to share the source code of the execution system with everybody, right? You only need to share the basic ideas. Okay, so I think that's all from me, and thank you for joining us. So let me take some look at some questions.
Yeah, thank you, Ernie. Just want to remind people you can type questions into the sidebar. We've already received quite a lot of questions, so we're going to get to as many as possible. So take it away, Ernie.
Thank you, Phoebe. So the first question is easy. Somebody asked me if I plan on coming out with another book. He said he or she has the Quantitative Trading and Algorithmic Trading. Well, actually, I have a first book called Machine Trading that was published in 2017. So that was already out last year. And so, yeah, please feel free to take a look at that. What is the most successful model? Well, I would say that one of the most successful model I created was a Forex model that we have traded for a few years with great returns. That model has, just like many other models, has suffered a significant alpha decay in the last 2 years. When it was the return on investment is not a good metric to measure in model because that depends on a leverage, right? If you leverage 10 times, you get 10 times the return on investment. So I think that so I think a Sharpe ratio is probably a better measure. I believe that during the time that it was working very well, it had a Sharpe ratio of greater than 3. So what is the advice for a software engineer to get into quant finance? Actually, I found a lot of software engineers being quite successful, become quite successful quant traders. In fact, my former boss in one of the hedge funds started out as a software engineer. So I think the best way for a software engineer to get into quant finance is to read about other people's model and start by backtesting them, trading them, building an execution system to trade them, and look for ways to improve it. But as I said, take a team approach. If you think that you have strong coding skill, partner with someone who has fundamental knowledge but no coding skill. That's the best way to get into it. Partner with a mathematician, partner with a MBA, go to the meetups and find like-minded people who have different skills. That's the best way to get into quant finance. What methods do you suggest to predict volatility? Oh, there are many methods, from the usual GARCH model to using recurrent neural net. There is tons of them, but I find that even the simplest model work very well in practice. I think that typically volatility can be predicted up to 1 month. Is not a problem. And whether I suggest trade strategies only in the preferred regime. Certainly, if you have a long volatility strategy, certainly you want to trade it only in a situation where the volatility is increasing. Right? Yes, regime switching is very important. Meta model, you might call it. How about increased weight leverage when returns from the strategy is lower than the mean return? Okay. This is about how do we deal with the drawdown, and by use it decrease the weight if the recent return are lower than the mean return. Certainly makes sense. You can use Sharpe ratio, you can use mean, many other metrics that you can use to decrease the weight. Skills and qualification that I look for when hiring quant developers. Well, I mean, the main skill, of course, is their coding skill, and secondarily, the ability to have an understanding of the market, so basic understanding of the market. the nitty-gritties of the market, things like market order versus limit orders and so forth. The causes of alpha decay is most of the time is because there are too many quant traders, right? This is, as I said, it's a maturing industry, and many of the fundamental funds are hiring quant trader and give them capital to trade. So it's competition causes alpha decay. And how do I decide when a strategy has too much alpha decay? Well, that or whether it's a temporary regime change. Well, that certainly is a good question. Essentially, when you are not making money, you should keep decreasing its leverage to a point where it doesn't that the P&L is simply noise in your portfolio, right? I mentioned the question is I mentioned studying a phenomenon and not looking for patterns to make money. That is true. I actually didn't say that I'm not looking for patterns to make money. I'm talking about looking for patterns and looking for phenomenon. They are synonymous. I am talking about, however, not immediately only interested in those patterns that are immediately applicable to a trading strategy. It is, as I said, it's a very analogous to physics and electrical engineering, right? In physics, we study a lot of materials properties, and in engineering, we are looking for materials that we can use for making electronics or whatnot. So, but in physics, you don't study a material only because it is useful to be made into electronics. You study the material because if there are some interesting properties. And then later on, maybe these properties can be used for engineering. So you just apply the same attitude to trading, to finance. A question about as a beginner starting with quantitative and no market knowledge, where can I start looking for strategy? Again, as a beginner, you have to look at what is your competitive advantage, right? If you are a programmer, partner with someone who need programming skills but have market knowledge that you lack. If you are a MBA, okay, you are beginner with in quantitative trading, but you are an MBA who has great knowledge reading financial statement. Well, partner with a programmer who can leverage your knowledge of financial statements. So you must look for your own little niche, what you can offer to that some other person where as a team you can exploit the opportunity in quantitative trading. Okay, so there's a question. How does better risk management make it last longer? Well, I mean, I thought that's kind of self-evident, because if you don't lose money, even if the strategy make less and less money, but as long as you don't lose money, you are still able to run it. You should still be able to run it, right? Unless the return is so small that you are no longer justify the cost of capital. Question is, given unlimited computing resource, is it always better to use more data in machine learning algorithm? Yes, certainly. More data. Okay, this is good point. Market structure changes, and so if you're using more data, I think by more data you mean you are using longer history. Okay, well, there are ways to get more data without extending it further into the past, and that is a simulation using the existing data and apply bagging. Okay, this is a machine learning term, bagging, to generate more simulated data, and also to capture the statistical properties of your data and simulate more of the similar data. Okay, so that's something actually I'm going to talk about in Quant. So, but yes, there are ways to generate more data that are not older. Okay. So there's a question of whether we should look for financial derivatives rather than simple cash instrument. Certainly, yes. If you have expertise in constructing a financial derivative, all the power to you. I mean, I'm sure there are opportunities there. I mean, it's just that everybody have their expertise and niche, and if you look hard enough and long enough in that particular area, your chances are you will find something that other people have overlooked. Okay. I think we are almost, wow, that's quite a lot of questions, so I don't think that we can cover all of them. So let me take, go to the, well, I should go chronologically. So let me see. There are top 3 sources for equities data for back testing. CRISP data is the gold standard. CRISP data is from the Chicago no, I'm sorry, the Center for Research in Security Prices. That's they are quite expensive. Secondarily, you can look at tech data, also very expensive. It's nothing cheap. Cheap data is no good, and good data never cheap. So so that's I think 2 of them are quite enough. You need a big budget to actually purchase any of that. How do you determine the stop loss for well, that's too general, so let me skip that. Let me just go through, pick some highlights.
Just to jump in real quick, Ernie, so I think we have time for 2 or 3 more questions. As he shared, everyone, we got over 50 questions, so unfortunately we can't get to all of them tonight. If it's a question you really want answered, please email me at events@quantopian.com, and we'll try to get you that answer. And like Ernie said, he'll be touching on a lot of this at QuantCon. So Ernie, I'll let you take 2 or 3 more questions.
Okay, sure. What do you think about momentum trading? Well, momentum trading is great in this current environment because the current environment, momentum strategy are what people call long volatility strategies or convex strategy. Momentum trading typically benefit from tail movement. So this is the good environment for that. Okay, risk parity versus equal weight. I think I prefer risk parity because equal weight is kind of too simple, right? I mean, we don't want the strategy that have the high 10 times higher volatility to dominate the P&L. So definitely risk parity will address that problem. So I'll take one last question. Let me scan. Some open source tools to get started. Well, Python is what everybody's favorite open source tool, and there's so much out there, including on Quantopian, naturally, that you can make use of. So yes, certainly Python is a good open source tool to use to get started. So I think that's all we have time for. Thank you, everyone, for coming. Thank you, Phoebe.
Yes, thank you so much, Ernie. Thank you, everyone. Once again, Ernie will be at QuantCon. You could read about his talk at quantcon.com. We will also have some of his books there, so we hope to see you there. And thank you for all the great questions. Again, if you want something answered, please email me at events@quantopian.com. Thank you, Ernie, and have a great night, everyone.